Silver didn't just move, it split. Right now, not last month, not some forecast, right now physical silver in Shanghai is trading $16 to $18 above US futures. That puts Chinese silver pricing near 128 while Comex spot hovers around 111. That's not volatility. That's a valuation war between paper and metal. If you're stacking silver watching metals or still trusting futures prices to tell you the whole story, this matters today. Not next week. Today. And if you're watching this video right now, you're already ahead of the crowd still arguing about candlestick patterns while the physical market votes with actual cash. I'm going to show you the patterns behind this split. Patterns you'll recognize again and again, and exactly what to watch this week to stay ahead of what's building. Here's why this gap exists, and why it rarely closes quietly. Quick ask before we dig in. If this kind of market intelligence matters to you, the signals that move before headlines, hit subscribe. We're building a group that watches what's ignored until it's too late. Let's be clear about where we are. The divergence isn't subtle anymore. Chinese buyers are paying a premium that historically screams one thing: physical scarcity. When paper markets and physical markets price the same asset this far apart, someone's wrong. And physical markets don't bluff. They vote with capital, not leverage. But here's what almost no one's tracking. While everyone stares at the premium, Comex inventories are draining. Fast. We're talking near 1 million ounce withdrawals in single days. That's not normal distribution. That's stress. And it gets louder. Delivery preference is shifting. Shanghai buyers aren't chasing paper exposure, they're demanding immediate metal. That tells you everything about confidence in the paper pricing mechanism. This isn't a chart anomaly you trade around. This is a physical signal about structure. Your job isn't to predict where silver goes next. Your job is to understand what this divergence actually means and recognize the pattern when it shows up again in 6 months or 2 years with different numbers but the same mechanics. Let me show you the first mechanism. Call it what it is. Paper anchor versus physical escape. Here's how it works. Futures markets aren't just price discovery. They're pressure valves. They absorb volatility through leverage, derivatives, cash settlement. Most participants never touch metal. They're trading exposure, not atoms. And that works beautifully as long as physical demand stays predictable. But when physical buyers show up in size, industrial users, sovereign entities, large stackers who actually want delivery, the valve starts to clog. Think about that. The paper market is built to handle massive notional flow with minimal metal movement. It's efficient. Until it's not. Right now, you've got bullion banks holding short positions, industrial buyers quietly hoarding for supply chain security, and exchanges watching registered inventory bleed out day after day. The shorts are leaning harder into a market that's physically thinning. That's the setup. The mechanism repeats because leverage masks scarcity until delivery actually matters. You can short 10,000 ounces on Comex, with a fraction of the capital required to buy and store 10,000 physical ounces. So the paper price stays anchored, calm, orderly, manageable. Meanwhile, physical buyers in Shanghai, Singapore, or anywhere metal actually changes hands or bidding higher. Not because they're dumb, because they need metal, not contracts. We've seen this script before. Different years, different commodities, same pattern. Palladium in the early 2000s, rhodium in 2008, nickel in 2022 when the LME had to halt trading because physical reality overwhelmed the paper structure. The labels change. The mechanics don't. Here's what matters for silver right now. The premium you're seeing, $16 to $18, isn't just elevated. It's a symptom of delivery preference. Chinese buyers could access Comex contracts. They're choosing not to. They're paying up for immediate possession in their jurisdiction. That tells you the perceived reliability of Western delivery channels is being questioned. Maybe not publicly, maybe not officially. But capital allocation doesn't lie. And here's the part that makes this dangerous for anyone on the wrong side. Premiums move before prices, always. The paper price is the last thing to adjust because it's the most leveraged, the most liquid, and the most influenced by positioning and sentiment. But when physical tightness reaches a threshold, when enough buyers decide they don't trust settlement, don't trust delivery timelines, don't trust warehouse inventory counts, the premium gap becomes unbridgeable. Then the paper price doesn't glide higher. It gaps, not telling you that happens this week, not predicting a moonshot, showing you the structure so you recognize stress when it builds. Circle this. Futures markets suppress volatility until physical demand overwhelms delivery channels. Then premiums tell the truth. That's the first pattern. Now let me show you the compounding layer. Second mechanism, inventory drain to rationing to repricing. This one's simpler and more dangerous. Metal leaves warehouses. You can track this daily on Comex registered inventories, the stuff actually available for delivery. When those numbers drop consistently, especially in chunks above 500,000 ounces, that's not routine shuffling. That's somebody pulling metal out because they either need it or don't trust the custodian. Right now, we're watching exactly that. Inventories aren't just drifting lower, they're being drained with urgency. And every ounce that leaves tightens the noose on anyone who's short and might actually face delivery demands. Here's the sequence. Stage 1, metal leaves quietly. Warehouse stocks decline. Most people don't notice because spot price isn't screaming. Shorts get comfortable. They see stable prices, assume ample supply, keep rolling positions. Stage 2, physical buyers start bidding higher, not in futures, but in physical channels. Premiums widen. Dealers start using careful language. Extended lead times, allocation limits, premium adjustments, nothing alarming, just subtle friction. Stage 3, rationing, not official, not announced. But if you're trying to buy serious size, say, a few 100,000 ounces of physical silver for delivery next month, you start hearing, "We'll see what we can do," instead of, "Sure, here's the price." That's when you know. Stage 4, repricing. The paper market either catches up fast or it breaks. By breaks, I mean you get scenarios like nickel on the LME in March 2022. Prices doubled overnight. Trading halted. Positions got forcibly closed. Billions in losses. Why? Because the exchange couldn't reconcile paper positioning with physical reality. I'm not saying silver does that next Tuesday. I'm saying the pattern exists. It's happened before. It'll happen again. And right now, the early stage signals are flashing. Let me put you inside this for a second. Imagine you're a bullion bank. You're short silver, maybe hedging mining production, maybe pure speculation. Your risk models say you're fine because Comex inventories are still in the millions of ounces, liquidity is deep, and you can always roll or settle in cash. But then inventory starts dropping. Not a blip, a trend. You check your delivery obligations for the active contract month. Suddenly the math gets uncomfortable. If more longs than expected stand for delivery, you might actually need to source metal. And if premiums are already $16 to $18 above your futures position, your hedge just became a liability. Now multiply that by every other short in the market, watching the same numbers. That's how stampedes start, not with headlines, with quiet math that stops working. Could this reverse? Absolutely. Inventories could stabilize. Premiums could narrow if Shanghai demand cools or if new supply floods registered stocks. Happens all the time. That's why your job isn't prediction, it's pattern recognition. But here's the thing, if withdrawals continue for another 2, 3, 4 weeks and premiums don't compress, we're not in a normal supply-demand adjustment anymore. We're in a structural repricing event, and those don't resolve gently. Here's what you need to sit with. The question everyone's asking is wrong. They're asking, is silver going to 150, 200? That's noise. The real question is, can the paper market still set the price? Because if physical buyers in Shanghai, Mumbai, or Zurich decide that Comex futures no longer represent deliverable reality, if they stop checking Comex spot and just bid whatever secures metal, then the entire pricing mechanism shifts. Futures become a side bet. Physical becomes the anchor. And anyone who thought they were hedged through paper derivatives wakes up to discover their hedge only worked in a world that no longer exists. I'm not saying that happens this month. I'm showing you the stakes. For shorts, rising delivery risk, impossible hedges, potential forced covering. For exchanges, credibility on the line if they can't deliver against obligations. For physical buyers, validation if they paid premiums early. Risk if they waited. That's the setup. Now let's talk about what to actually watch. 3 scenarios from here. Not predictions, frameworks. Scenario 1, stabilization. Premiums narrow back toward historical norms. Call it $6 to $10. Comex inventories stop bleeding or even rebuild as new supply gets registered. Delivery demands stay routine. Shanghai buyers pull back. If that happens, tension releases. The paper pricing mechanism reasserts control. Shorts exhale. Life goes on. Who benefits? Anyone holding paper shorts, exchanges, anyone who wants orderly markets. Who feels pressure? Early physical buyers who paid peak premiums, stackers hoping for a squeeze. Scenario 2, stress. Premiums widen further, say $20+. Inventories keep draining. Delivery language from dealers shifts from extended timelines to allocation only or minimum order sizes. Lease rates spike. EFP spreads, essentially the cost to swap futures for physical, blow out. That's stress. Not a break, but sustained tension. Markets stay functional, but the cracks show. Who benefits? Anyone already holding physical, dealers who can source metal, refiners with inventory. Who feels pressure? Shorts scrambling to cover, late buyers facing higher premiums, anyone assuming smooth delivery. Scenario 3, break. Premiums become irrelevant because you can't get metal at any reasonable price. Inventories hit levels where exchanges question whether they can honor delivery. Paper reprices violently higher, maybe in a single session to close the gap. Or trading halts while participants in clearinghouses figure out what's real, low probability, high impact, who benefits, physical holders who secured metal early, no one else. Who feels pressure? Everyone still in paper thinking they could convert if needed. I can't tell you which scenario plays out. Could reverse tomorrow, could grind into stress for months, could snap in a week, but I can show you what to watch so you're not guessing. Here's your watch list, this week, this month. First signal, Shanghai Silver Premium. Track it daily. Normal is $6 to $10 above Comex. Stress is 15 plus. Crisis is 25 plus. Watch the trend, not the snapshot. If it's widening consistently over days or weeks, that's physical demand accelerating or supply tightening. If it stabilizes or compresses, tension's easing. Where to find it? Financial data providers, metals-focused sites, Shanghai Futures Exchange data. Second signal, Comex registered inventory changes. Check the daily warehouse stock reports. Look for net changes, especially drawdowns above 500,000 ounces in a day. Normal is gradual drift, up and down, net neutral over weeks. Stress is sustained one-way bleeding. Crisis is million-plus ounce withdrawals becoming routine. One big withdrawal isn't the story. The trend is. Third signal, lease rates and EFP spreads. These are technical but crucial. Silver lease rates measure the cost to borrow physical metal. EFP spreads measure the cost to exchange futures for physicals. When both spike, it means physical metal is tight and expensive to access. When they're calm, supply is ample. Normal? Lease rates near zero or slightly negative. EFP spreads tight, low single digits. Stress? Lease rates positive and rising. EFP spreads widening to double digits. Crisis? Lease rates screaming higher. EFP spreads so wide they indicate physical delivery is effectively unavailable at futures prices. Fourth signal, backwardation. This is when near-term futures contracts trade higher than later-dated contracts. It's the opposite of the usual structure and signals immediate demand overwhelming forward supply expectations. Normal is contango. Later months cost more. Stress is flat or slight backwardation in front months. Crisis is deep backwardation across the curve. Fifth signal, dealer language. This one's qualitative but powerful. Watch what dealers, refiners, and mints say about availability and lead times. Normal language sounds like standard delivery timelines, spot pricing, ready availability. Stress sounds like extended lead times, premium adjustments, subject to allocation. Crisis sounds like not taking new orders, existing clients only, delivery uncertain. Language changes before prices do. Now here's the key. Risk clusters. One signal flashing doesn't tell you much. Premiums can spike on temporary demand. Inventories can drop then refill. Lease rates can blip. But when 3, 4, 5 signals align, that's your pattern confirmation. If premiums are widening and inventories are draining and lease rates are spiking and backwardation is developing, that's not coincidence. That's structure under stress, not advice, pattern recognition. Your job is to watch, interpret, and understand what's building, not front run or hero trade every wiggle. Can't know timing, only structure. And structure right now looks tighter than it has in years. Let me bring this home. If you're watching premiums instead of just spot price, if you're tracking inventory flows, not headlines, if you're paying attention to dealer language and delivery friction, you're in the group that sees stress early, not the group that panics when CNBC finally covers it, not the group that chases after the move is over, the group that understood the structure while it was still building. That's the edge, not prediction, not perfect timing, just knowing what matters and watching it consistently. Physical markets don't negotiate. They don't wait for consensus. They whisper through premiums, through inventory, through delivery friction, then they shout through price. And right now they're whispering loud. Comment below. Which signal would worry you most if it kept escalating? Premiums, inventories, backwardation? Let me know what you're watching. And if you've already experienced delays or higher premiums locally, share it. That's real-time data the rest of us need. Before you go, subscribe if you want more of this. Not hype, not predictions, just patterns, signals, and the mechanics that repeat whether we're talking silver, oil, grains, or anything physical that trades against paper. Hit the links below for inventory trackers and premium data sources. Tools matter. Final thought. Physical demand doesn't ask permission. It just shows up. And when it does, the market that thought it was in control finds out whether its pricing mechanism still works. Stay sharp.